Hey everyone, welcome back to the channel. In this video, I want to do an update on my intrinsic value analysis calculation for Smith & Wesson stock, Smith & Wesson being the American gun manufacturer. They recently had earnings that sent investors into a bit of a panic, I suppose, not unlike the last earnings call, I guess. But I want to take a quick look here to see if anything has potentially changed with the overall investing narrative, at least from my own perspective. As always, I have to emphasize that you should do your own research before investing into any stock. I'm not making a recommendation either way for your own portfolio, because your portfolio might look very different than my own, and your risk tolerance and risk preference might also be very different from my own. So again, do your own research. And if you're looking for it, seek the advice of a licensed financial professional, because I am not one of those. And just to be clear, I am a current Smith & Wesson shareholder. And for those of you who don't know, Smith & Wesson is an American gun manufacturer. They've been around for a very long time, and they recently came off some record sales years when it came to 2020 and 2021, partly due to some of the instability that was going on both in the US and really throughout the world, and also because election years in the US tend to kind of have these sort of sentiments, because there's a lot of political talk that goes towards sort of the whole gun space, and people might get scared that there are going to be higher restrictions or something like that, and you see a lot of demand often in election years. Of course, it's not an exact science, but that seems to be a general sort of trend. So I suppose you could say it's a cyclical sort of business, but not exactly. If we go ahead and take a look at their overview here on ticker, Smith & Wesson Brands designs, manufactures, and sells firearms worldwide. The company offers firearms products such as revolvers, pistols, modern sporting rifles, bolt-action rifles, and muzzle loaders, handcuffs, suppressors, and other firearm-related products under the Smith & Wesson, M&P, Performance Center, Thompson Center Arms, and Gemtech brands. And if we show their stock chart, they have seen better days. They reached a peak of about almost $36, $35.50 back in July of 2021, and they've come all the way down to about $15.78 as of the close on Friday. I'm filming this on Saturday, so we'll see if anything changes if I don't get this video out by the time the market opens on Monday. But a couple not stellar earnings calls in a row have really helped to plummet the share price down, and the market cap now sits at around $718 million. So quite a bit off their recent high. If we actually go to the year-to-date view, they are down already about almost 12%, 11.5% to start the year. Now let's take a quick look at the financials. I always like to start with the balance sheet to see what we're working with. I would definitely recommend checking out my initial video I did on Smith & Wesson a few months ago when I actually opened up my initial position into it, and I've added since then. So I would definitely recommend checking that out first, and you can kind of see how maybe things have changed, and if you want to adjust your own narrative based on kind of what has happened historically just over the past few months. I'll go ahead and link that in the description. But I'll mainly be looking at this last 12 months column on the far right, because that takes them up to their most recent earnings call, and then obviously goes back the previous 12 months. So it's looking at the last year of earnings. And right now they're sitting on around $100 million in cash. And they're also sitting on a pretty large stock of inventory right now, but not too much in the grand scheme of things. If we look at 2019, they had about $163 million in inventory. Compare that to 2021, where they seemingly couldn't sell enough, and also 2020, where they fell below kind of their historic trend of kind of the low $100 million in inventory. They're now back, I guess, towards that historical trend, if you can call it that, of about $130 million in stock. We scroll on down to their debt. We can see what's going on there. And hey, look at that. They cleared their long-term debt. That was one big thing they did with their huge influx of cash that they had in the past couple of years. So that's great. No worries there when it comes to long-term debt. They do have some pretty significant leases in 40 million or so in capital leases. But compared to their $100 million in cash, really not all that much to be concerned with, at least on the balance sheet side. But also, let's take a quick look at shares outstanding. Have they been issuing shares? No, they have been buying back shares. You can see the share count is going down pretty rapidly, at least over the past few years. They bought back a few million shares just in the last year. So it's good to see that sort of trend, returning capital to shareholders that way, because what happens when a company buys its shares back is that there are now less shares outstanding. So each existing shareholder now has a greater share of the overarching business, because there are less shares in circulation. And you can think of it a lot like inflation with a currency. There are less sort of units of the business going out there, but there's still the same amount of profits. So you have less shares for the same underlying business. Therefore, each shareholder gets a greater share of the business now. This is the opposite of share issuance, which causes causes what we like to call dilution, where now each shareholder would have less share of the overarching business because there are now more shares out there. That is not what's happening here. We're getting the opposite with buybacks. And Smith & Wesson has emphasized that they are trying to continue to do this, so we'll see how much their share count comes down in the next couple of years. Let's take a look at their revenue numbers. We'll go over to the income statement, see what the top line is looking like. And last year, they still had a wonderful year when it came to revenues of about $1 billion, which is well above kind of their historic sort of trend line. If we take a look at this graphically, we could look at the last 5 years, definitely higher than normal. This actually only shows you up to mid-2021, but they were at about the same level for the last 12 months. So you can just kind of imagine this same sort of bar right here. So higher than normal. The closest we got was back in 2017, which was at about $900 million, or I guess this would have been 2016 into 2017 because it's a little bit off right now. It's April to April rather than January to January. But either way, certainly higher than what it normally sits at. Normally, we're looking at closer to, say, $500 million in revenue. So top line is much higher than it normally is. But you could see that there is kind of a trend here. This was 2016 into 17, 2016 being an election year. So whenever you get sort of political instability, if you can call it that, or more like political kind of negative sentiment, in that there's now a change in the positions of power, you see a lot of people tend to buy guns, I suppose, whether it be justified or not. That is what people tend to do. You see a lot more gun sales during election seasons. Let's go back to 2012 and see if we can see the same sort of thing. Yeah, you can see a bit of a spike here from 2012 into 2013. So it definitely seems like there's something to that kind of thesis that during election years, especially if there's a change in parties, I guess, you might tend to see more gun sales just because of uncertainty. It's definitely a pretty strange space, to say the least. But that's just the top line. Let's go ahead and take a look at their cash flow statement. And I'll actually put this back up to just the last 5 years or so. And then we'll remove revenue from this graph here. And let's take a look at free cash flow, which is what I always like to take a look at with any stock I'm looking at. How much cash flow they're really throwing off at the very end. This is kind of the lifeblood of the business, as it's often called, in that this is the money that a company can use to issue dividends, buy back shares, reinvest in the business, do all the great things that you like to see a business doing as a shareholder. So that's one thing I always like to look at. And you calculate free cash flow by taking cash from operations minus capital expenditures. And when you subtract those two things, you get your free cash flow. Now, again, kind of like the last graph, this only shows you from April 2020 into April 2021. And there you can see they had a monster year free cash flow wise of about $300 million in free cash flow, well above what they have done historically. And if we look at the last 12 months, we can see that they're still above $200 million in free cash flow, which again is still well above their historic trend. So free cash flows over the last 12 months have still been quite high. Hey guys, real quick, definitely check out the affiliate links that I have in the description below to Webull and Robinhood. They're going to give you some free stocks if you sign up for those accounts there. I get some free stocks as well, so it's a win-win. Go ahead and do that now. It is free money.
It's free real estate.
But let's break this down a little bit more into a quarterly view because we want to see what the trend is more recently. So I'm going to narrow this view a bit to the last couple of years. And this is their most recent earnings. We can see that cash from operations minus capital expenditures was almost break even. So they had a couple $2 million in free cash flow over the last quarter. So really not all that great in the grand scheme of things. We can actually do this graphically as well. So this is a quarterly view now of free cash flow. You can see it has come down pretty dramatically over the last couple of quarters. But why is that? Let's take a quick look at what's going on here. Well, we can see for one, a change in inventories has certainly been fluctuating. There, you can see right here that there's been a lot more money thrown into adding to inventory, perhaps due to supply chain issues, perhaps due to trying to anticipate future demand. And I don't want to call this like a sort of cash equivalent in that they're changing their cash into inventory, but it's not as though this is a total net loss. They still have something there. They have more guns in stock, for example. Now, this doesn't mean that they might not have to cut prices significantly to remove all this inventory that they have to make way for new stock or whatever it is. So it's not as though it's risk-free by any means, but do keep in mind that a lot of their cash flow drain, at least in the last couple of quarters, has been towards adding to inventory, which you did not see over the last few quarters where they actually had a net loss in an inventory, which would make this number positive on this side. But if we go on back to their income statement, sticking with the quarterly view, we can see that revenues are definitely lower than what they have been over the last few quarters, but really, again, not all that different from sort of the more historical trend. But if we go on back to their income statement, let's take a look at the top line and see how that's changed over the last few quarters. So extend this out a bit. Let's take a look at revenues on a quarterly basis. You can still see that revenues are pretty high, again, historically speaking, or I guess more normalized, I suppose, around that kind of $170 million million mark in the last quarter. Compare that to the pre-election year of 2020, where you see that revenues were hovering more around, again, that 170 million mark, at least on a quarterly basis. So it seems like it's normalizing a bit, though we'll see what happens in the next year, especially with all of this potential instability from kind of more worldly affairs. We see the Russia-Ukraine situation, of course, and maybe people are going to get more nervous about that. It's sort of like a weird sort of sentiment play, I suppose, the gun space, and that the more uncertain people are, the higher you tend to see gun sales. But there's also a very strong culture, I suppose, especially in the US, to gun ownership and recreational gun use. And we'll take a quick look at how background checks have changed as well, since that's something I looked at in my last video on Smith & Wesson. And I think that is sort of telling on kind of what the general interest is for the population in buying more guns. So why don't we go ahead and take a look at that right now? It's been a few months since I did my last video on Smith & Wesson, which I believe was in November, if I'm not mistaken. And we saw that the trend in background checks was still coming down, but historically speaking, still very high. This total number on the right is the number of background checks that have been issued on a monthly basis, and then it's totaled up into annual in this totals column. So in 2021 and 2020, we had really record years for the amount of background checks issued, which would indicate that there might be some greater interest towards buying a gun. Because if someone's getting a background check, that probably means that they're trying to buy a gun. Doesn't mean they actually buy guns. This isn't like a sales number, but it is definitely indicative of interest, or at least the number of people who are looking to buy one, because that's why you would get one of these. So if you look at the last couple of months, January and February, it's come down a bit since sort of the average in 2021 was, I'd say, closer to 3 million, but it's down to about 2.5. Granted, there were some months in 2021 that were around the 2.5 million mark. It's actually pretty consistent with what happened in the second half of 2021. So maybe if it continues that pace that we saw for revenues in quarter 3 and quarter 4 of 2021, let's just say I wouldn't be surprised given these background check numbers if they are in fact indicative of overall gun sales. But anyways, I do want to pay attention to this because it does kind of give a very high level sort of interest gauge on the amount of people that are looking to buy a gun. It's by no means exact, but it's something. So now we get to the tricky part of trying to value Smith & Wesson, and this is a discounted cash flow model, which takes all of their cash flows over the next 10 years and then discounts them based on my own discount rate, and then it spits out a value from there on what you should pay for the company if these assumptions were to come true. I'll quickly go through the input factors here right now, starting with excess capital down here, which takes their cash minus their long-term debt. I just took their $100 million in cash minus the 30 million or so in leases. That gets you $70 million in extra cash that you would add on to your final valuation. I'm using a year zero free cash flow number of $100 million, which is closer to kind of their more historic average, at least over the past few years, not so much into these insanely high levels of more like 300 million or even 200 million over the last couple of years, where you saw very high free cash flow. I'm going to use 100 million just kind of as our base case, though I'll do some tinkering here and show you how the base case might change based on how you change this number. And this number right here is our terminal multiple, which is the final multiple assigned to the year 10 cash flows to kind of get you a liquidation value of the business. And here I'm only using 8, which is definitely low compared to most stocks, at least most mature sort of companies in the broader stock market. And I'm doing that because of the general negative sentiment that you see with quote unquote sin stocks, alcohol, tobacco, firearms, that sort of thing. So I'm actually going to leave it below 10 in this case, all the way down to 8. Normally, I'd like to use something closer to 15, which is probably more in line with a more historic average for most stocks. But I'm going to go ahead and discount it here, just discount it even more to try and build in sort of some extra margin of safety in the event that you see more and more negative sentiment towards guns over the long term, which I guess really isn't all that unlikely. And for discount rate, I normally use about 15%, which would imply that if all these assumptions came true and the market priced things just according to this model, I'd be getting at least a 15% return per year on average. So that's kind of what it's getting at. But I'm going to go ahead and bump this up to 20%, which would add even more margin of safety within the actual base analysis before we even get to the final valuation where we have this sort of margin of safety calculation down here. Now, growth rate. I'm going to go ahead and just leave it at 0 just to kind of get sort of this base case here where it stays at $100 million per year every year for the next 10 years. So we take our year 0 cash flow, multiply it by the growth rate each year, which in this case is 0%, so there's no growth. Then we multiply our year 10 cash flow by our terminal multiple, which gets us sort of our final value of Smith & Wesson at the end of 10 years. We then discount all of those cash flows by our discount rate, and then we add them all up to get a present value of future cash flows of $550 million. Then we add on our excess capital number of about $70 million to get us an intrinsic value of $620 million, which is actually below the current market cap of $720 million. So that would imply a margin of danger of 14% if we're looking at a 20% discount rate. But this is a pretty conservative analysis, I would say, but of course it depends on your own sentiment on what you think is going to happen with the gun industry. But let's go ahead and add a little bit of cyclicality here to make it a little bit more accurate, because as you get further out in the analysis, the discount rate compounds on your assumptions here. So your year 8, 9, and 10 cash flows are going to be more heavily discounted than your year 1, 2, and 3, because there's simply less time for that discount rate to kind of compound on your assumptions. Let's say, given all the fear and global instability that we're seeing in this first quarter of 2022, that 2022 ends up being another strong year for gun sales, and you see something more like $150 million in free cash flow for the first year. Then maybe the second year, perhaps it drops down a bit back to $100 million, but we are getting into an election cycle shortly thereafter. So maybe this third year, it's election year again, we're back up to $150 million, because who knows what happens. And it sticks there for another year after the election's over, falls back down to $100 million, maybe falls even down further to, I don't know, $80 million. It sticks there for a couple of years until maybe you get one more big year because of instability up to, I don't know, $120 million, and it falls back down to $80 million, something like that. Now, all of a sudden, it looks like the margin of danger is a little bit less. We're only at negative 7% compared to what we had before. And again, this is assuming a terminal multiple of only 8 and a discount rate of a whopping 20%. So you already kind of have some margin of safety baked in here, unless you really, really require a 20% return on whatever you're getting. And if we pump up this terminal multiple back up to 12, then hey, look, you're right at your fair value here based on all of these assumptions if the market says these things are true. One thing to notice with a discounted cash flow model in particular is because of the time value of money, if you can get your more money up front, that is going to be weighed more heavily in your valuation and analysis than if you got more money later, because of your discount rate, you're discounting the future. So when you're given the choice of getting $1 today versus $1 10 years from now, you're always going to take the $1 today, because you can do things with it and compound it from there rather than waiting, watching the time value of money weigh it down, inflation, all those great things that you don't want to see. So you'd rather get the cash now and do something with it. And in this adjusted model, I have more of the cash flows coming up front than later. So that would imply that sort of it's front loaded in that way more so than it would be if it was a stable $100 million all the way through. So it's just something to keep in mind when you're working with something like a discounted cash flow model, in that the time that that money takes to get there definitely matters. But I thought I'd play around with the numbers there just to show you how kind of some of the mechanics work, and also to show you some of the different scenarios that might play out and how that might actually fit your own investment thesis. Of course, definitely do your own research. I'm not saying any of these scenarios will actually happen. However, I am invested in Smith & Wesson, and I have added a bit recently. I'm looking to potentially add some more, but it's one of those stocks that I don't want to become too much of my portfolio, just given, one, the cyclicality of it, also the inherent political risks associated with owning a gun company and just something exposed to the gun industry in general. It's not something that is looked on too favorably by many regulators and many people in general. But if you're interested in this sort of space, it's definitely an interesting opportunity to take a look at. Like I said earlier, I'm not recommending that you buy Smith & Wesson or that you believe any of these assumptions. It is up for you to make your own decision, and that comes with any sort of investment. It is up for you to decide and do your own research. But with that said, if you like this video or found it interesting, then definitely like it, since that would help the channel out a lot, and be sure to subscribe since I put out new videos every single week and wouldn't want you guys to miss out. Until next time, take care.